Hey everybody, so diversify is the worst information that can be given by these talking heads. So diversification is a total scam, and it was invented by the finance industry, the front-end finance industry that's always trying to get your money from commissions and fees. Money managers, financial planners, hedge funds, Dave Ramsey, all these people that make money off of selling you products and selling you so-called safe things and safe products. This was invented by them to pull the wool over your eyes. Diversification takes the consequence of ignorance and laziness on the parts of financial planners and hedge fund managers and those kind of people. It takes the burden of their ignorance and stupidity, and it places it square on your shoulders as the one putting forward your capital. And I'm going to explain how that happens. So first of all, what does diversification actually mean? It comes from the root word, to divide, to divert. So I'm going to take my capital, theoretically, and spread it out over a larger area, and it'll protect me from disaster. Imagine a farmer who, instead of planting all of his apple trees in one field, plants like half of them over here and half of them over there, and puts corn here and beans over there. So when there's a big fire, if it takes out one field, he still has 3/4 of his product that didn't get touched. So in principle, it sounds really cool, and these people will use this diversification analogies in the same way, and they'll make you feel so mature and so wise, and you're so prudent and you're so safe because you diversify. And you'll hear like your average Joe, like grandpa investor, 401k kind of guy, like, I diversify, I believe in diversification. And they're really just parroting something that they heard from TV. They don't even know what that means. And it's just a big scam, and I feel really bad for most people because they believe in this stuff and they don't know what's actually going on. So try to cover your laziness. That's what diversification actually means. Let's use an analogy of diversifying our portfolio and see what could actually happen. Okay, so you want to invest in tech. You've got 3 stocks that you really like. You're real hot on tech. And so you want, like, let's say Amazon, NVIDIA, software. This Amazon could be considered tech because it's partly a tech deal. And then you've got, another tech stock like Microsoft. MSFT. Okay, Microsoft. So you're real hot on these tech stocks, and you've done your research, you're a good trader, you're practicing good principles, and you're really excited, but then you get on television or you get on your news feed on the internet, and you see one of these talking heads, and they're predicting that the market's going to crash. There's some new virus that's killing all the computers. The world's going to be over next week, and if you're really smart, you need to diversify. And so, don't all be in, tech or this one thing. Well, so you go, now all of a sudden, your confidence has been replaced by fear. You had really good feelings of confidence that you were going down the right path, and now all of a sudden, you just feel confused, you feel angry, you feel like really scared. More than anything, you just feel fear. So now you go back and you start scratching things off, and you got like, man, I really got to diversify. This key word, this slogan, this propaganda has now entered your brain, and now it's telling you what to do. You're brainwashed. The propaganda is informing your decisions on the market. So you don't even know what diversify means. You just think it sounds great because someone told you that. And so what you do is you go back and you say, well, I've got to keep one of these. So, all right, I'll keep my Amazon. I like Amazon. It's cool. And then NVDA, I could do away with that one. I've got to diversify. So what's something that's like not related to tech? I don't know, bulldozers. So you get some all right, Caterpillar, make some bulldozers and track hoes. That's diversification, buddy. And then, Microsoft, no way. I've got to diversify. So how about, I don't know, some big bank or something, finance. Oh, we've got Wells Fargo in town. They're a really cool bank. So WFC. Okay, so now I'm in finance, I'm in bulldozers, and I'm in like tech. So I'm set, man. Now I'm really gonna make some money, and I'm gonna do it smart because I diversify. Well, what actually happens? Anything can happen in the market. And what actually happens is tech, for the week, tech was going flat, and then all of a sudden it just took off, and then it really took off. And tech had a good 15% run for the past week or 2 weeks. So your Amazon did really well, and it might be up 10%. And so you made some money off of Amazon. So you're like, yeah. But guess what? This is why diversification doesn't work. Where did this money come from? This is all big money, okay? Us little guys don't really make a blip in these lines. Where did this money come from? Do you think money in the market just comes from nowhere? Like, do you think people in big hedge funds just print money? No, the money comes from money that's usually already in the market. Now, money can flow from bonds back into the market. New money can enter the market at any time. But typically, the market, what it's going to do is it's going to transfer money from one sector to the other, or from more risky to less risky investments, or vice versa. So tech is traditionally more risky because it's not traditional, it's not been around as long. It's also more prone to things going wrong. So the less risky investments, of course, would be things like heavy machinery, things you can count, things that you can, like lumber, things that have natural resources that can be counted and stacked up. That money that went into tech most likely came out of the safer industries. So, like cat. Cat probably went down a little bit that week because the money's piling in here, not into here. And then let's say with finance just, let's say, goes flat because it's going to be based on things more like interest rates and financial things. So it just goes flat. So you didn't make any money off of Wells Fargo. You actually lost money on CAT, but you made money on Amazon. So what does that mean? Okay? That means that instead of making all this money, like you could have made the full 15% move on your 3 tech stocks, Amazon, Microsoft, and Nvidia. Instead, you just let the broker play with your money right here. You didn't make anything. You lost money right here, and then you made a little bit. Okay? So you basically only made, let's say, 1/5 of what you could have made by just going into tech. So do you see how someone who's good in the market, someone who has market savvy, who knows how to trade, would have rode this thing to the moon and taken a bunch of profit? That's what real traders do, okay? They don't get scared by talking heads. They don't try to diversify when they know and have confidence that they've done their research and they've got a good trade lined up. They're not going to get deterred. Whereas the guys listening to the hedge funds and your little financial planner and stuff, what he's done is this is what he's done for you. And he wants you to make, you should just feel awesome because your account went up like 1%. This dude's account that had the 3 tech stock, his account went up like 10%. Yours went up like 1 or 2%, okay? And then the next week, this reverse thing happens and you lose all your money again. But this guy's already jumped out and he didn't lose any money. So I just wanted to explain that diversification is not really in our favor. Now, you might say, well, what if the opposite happened? If tech had gone down, I would have at least not lost as much. So hey, it's like, Josh, you're really on one, because you're not even able to see that, well, yeah, I didn't make as much, but I didn't lose as much if it would have gone against me. I understand that. But the way that we manage risk in the market is not by diversifying, it's by controlling our size. It's how we control the size of our trades, how we set our stop losses, or using options to control the price movements. It's really more in the sizing and the mechanism, the mechanics of how we trade, and not taking it and like spreading it out over this huge area is how we make money and manage our risk. So yes, we can be wrong a lot of the time, and we can make wrong moves. I make wrong moves all the time in the market, but I don't use diversification as insurance against that. I do my research, I use knowledge, and I use experience and the right tools to manage losses, instead of trying to use diversification to cover my ignorance, because this is not a good tool to use to manage risk. The greatest tool to manage your risk is going to be size and tactics, strategies. Strategy and size is a way to manage your risk, not diversification. So anyway, this is used by talking heads, and this is touted by those who don't know. This, along with strategy, is used by those who know, those who actually trade. And I'm going to make a video getting way more in depth about this and how to do it. I hope that helps. Don't buy into the diversification myth, and you have a great day.